Dear students, knowledge seekers and learners, welcome to lecture 5 of week 1 titled Importance of Financial System. Today we are going to focus on understanding several issues related to financial system. Initially, we will talk about conceptual basis of importance of the financial system, followed by financial system and economic growth and emerging relation between these two. After that, we will try to understand capital formation and investment process, which is very important for a booming financial system. After that, we will delve deep to understand the concept of allocation efficiency in a financial system, followed by understanding the role of financial systems in savings mobilization. We will after that try to understand and learn financial inclusion and development in terms of financial system, followed by stability and risk management. And finally, in today's lecture, we will try to understand the structural and development significance of financial system. Let us begin the journey. At the outset, it is important to appreciate the conceptual basis of financial system and its importance. The financial system is essential for the smooth functioning of an economy. This is very important because the economy cannot function properly without a financial system. A financial system acts as a backbone for flow of funds, and it is an structured and organized system that can bring order into the financial instruments, institutions, and markets. Financial system is also very relevant to the growth and development, which we will be discussing in the future slides. The conceptual basis of importance also highlights that financial system ensures that financial resources are mobilized and utilized efficiently. Not only this, but it is also important to see that effective utilization of financial resources is very important for growth and development of the economy. Every economy has resources. Every economy has financial resources. But the difference between two economies lies in the efficiency. If we have an A economy and a B economy, and both the economies are having XI financial resources. Now, both are equal, but the country which is better in efficiency, say for example, B is better in efficiency, then the outcome of XI will be more in terms of A, in terms of B, than XI in terms of A. Therefore, the whole process of credit creation, credit liquidity creation, and other such financial outputs and benefits will be more in case of a country which is having better efficiency. Thus, everybody may not have a scope to expand the resources immediately, but everybody can focus on improving efficiency. This particular efficiency is provided by financial system. Without financial system, savings remain idle and investments are limited. We have already discussed that financial system mobilizes savings. Suppose, imagine that there is no financial system. We mean to say that there is no organized financial system. Then the savings will be kept with the people and there will be no trust in the system. and therefore the savings will remain idle and will not be invested into the market, because of which the investment for a country will remain low. Though we cannot fully rely on savings as well, because the problem associated with developing countries in general is that developing countries lack domestic investment. That is why they require foreign direct investment. But still, considering this point to be valid, if we want to have more and more domestic investment, it depends on how savings are mobilized. It depends whether savings are used or they are not used. If they are remain idle in an economy, obviously there will be lack of domestic investment. Financial system also acts as the foundation of the modern economic activity. The modern economic activity is quite different from the traditional economic activity. Modern economic activity is characterized by different types of behavioral features, different type of inculcation of technologies, different type of peer-to-peer transfers, etc. Thus, financial system always provides a foundation for usage, development, and upgradation of new technologies. Just as an example, today everybody is using UPI, Unified Payment Interface. Now this UPI is part of modern economic activity. Who is supporting UPI? The whole financial system is supporting UPI. And because of which we can see that gradually the payments that are made every day, UPI is being used in those payments. This is a very classical and good example of modern economic activity. The financial system is supporting UPI transfers, UPI payments, and because of which this UPI is gaining its space in the financial system, and financial system is being benefited. Thus, it is very important to appreciate that the financial system which a country have is actually the foundation for the futuristic and modern economic activity. Thus, we can understand that financial system is not just supportive system. It is structurally necessary for organized economic development. It should not just be supported, but it should be structurally necessary for organized economic activity. Just to give another example, during COVID-19, when the world started shifting towards digital platform in terms of video calling, in terms of teaching, etc., we all are aware that there were several challenges, because the system at this time was not structurally made for transformation into a digital society or digital platforms. But gradually the system reformed itself to provide opportunity that structural changes may happen. And once the structural changes started to happen, we also started to see changes in different types of digital platform. The usage of digital platforms increased and digital space in our lives also went up. So this all happened because structural changes were possible. So the financial system should be structurally necessary. If it is not structurally necessary, then even if it is supporting new changes, it will fail to bring new changes. Let us now try to understand the linkages between financial system and economic growth. Economic growth depends on the availability and efficient use of capital, which is long-term finance. The financial system accelerates growth by channeling savings into productive investment, by supporting technological advancement, and by facilitating expansion of industries. It is very important to understand that empirical evidence suggests that financially developed economies grow faster. Thus, growth is not just about capital availability, but how efficiently it is allocated. Let us now try to understand capital formation process. Capital formation involves a process which starts from savings. When savings are mobilized, they can be converted into investment, and then the creation of productive assets starts in an economy. Thus, the financial system mobilizes the dispersed savings, then converts them into large-scale investments. It also enables long-term projects such as infrastructure and industrial expansion. Now, infrastructure and industrial expansion are again very important to further the growth and progress of the economy. It is only through long-term projects that we can have more and more possibilities of economic growth, economic development, modernization of resources, etc. And all this depends on how financial system and how much the financial system can create the capital. Now, this creation is very relevant, should be relevant and important, and there should be more and more avenues through which infrastructure and industrial expansion should be possible. However, it should be noted that without financial intermediation, capital formation remains limited and organized. Thus, there is also a need in the financial system to promote financial intermediation. The financial intermediation refers to the financial institutions, the brokers, the entities that provide a platform where the financial consumer and the financial service and the industry can interact. Dear students, knowledge seekers and learners, let us now focus on efficiency in resource allocation. A key function is directing funds towards higher return productive uses. Now, the highest return productive uses are important because everybody will prefer X0 and we have X1. We say that the return on X1 is equal to 15% and return on X0 is 10%. However, we are also saying that risk at this level is only 2% and risk at one level is around 5%. We know more risk, more return, less risk, less return. But obviously in a financial system, if this kind of scenario is there, then obviously the resources, the financial resources, the funds will always be directed towards those avenues that are giving more return, which we say the highest return productive uses. It also indicates that if there is more return, then in this case there is a possibility that this particular sector is performing in an efficient manner. Now, how generally this is achieved? This is achieved through interest rate mechanisms. It can also be achieved through market signals. It can also be achieved through the institutional credit appraisal. All these things contribute together to bring efficiency in resource allocation. Efficiency is the backbone of saving resources as well as utilizing resources in a proper manner. Resource allocation also reduces misallocation and improves economic productivity. That is why it is justified to say that efficient allocation determines the quality of economic growth. Let us now try to understand the role of financial system in savings mobilization. Saving mobilization encourages several things and thus provides advantages to the economy. It encourages savings by offering safety. That is, it can be put in a place where the assets will remain safe. There is no fear of theft. There is no fear of damage, etc. Second is the liquidity. Liquidity is where again the savings which are being kept in safe custody, in safe haven, can be taken back anytime depending on the need. So one of the bottlenecks with the people to save money in financial system remains that if I am putting money in a particular financial product, and if I need money in some emergency situation, it will take time to convert that saved money into the liquid cash or digital money. So this particular thing has been reduced in the financial system, and now easily the money can be taken back which is being saved, thus saying that the liquidity is also a feature which is being offered now. And third is return. If your savings are kept with banks and financial institutions, there is also returns which are being given. Thus, saving mobilization transform the unorganized savings into formal financial resources, thus expanding the scope of domestic financial resources, and then the same domestic financial resources can be transformed into domestic investment. Saving mobilization also increases the overall saving rate of the economy. It indicates the higher the saving, the higher is the investment capacity. Facilitating investment activity is another important feature which we need to take into consideration. Investment activity provides financial resources for business expansion as well as diversification. Entrepreneurship, bringing new ideas into the business economy. Infrastructure development. It reduces barriers such as lack of funds, information asymmetry, etc. Investment in terms of financial system becomes systematic because of the whole structural framework rather than just becoming incidental or accidental. Let us now try to understand financial inclusion as a development tool. Financial inclusion refers to bringing in more people into organized financial sector. As we know that countries with very high population also have people who are unbanked or underrepresented in the financial system. These people need to be brought in to the financial system, and which can be very beneficial. Financial inclusion expand access to banking, credit facility, and financial services. It integrates different marginalized sections into the formal economy, for example, women, tribal people, people with low income and no collateral, etc. This is not just a economic activity. This appears to be, and people have accepted that it is a social activity as well, because bringing people into the organized formal financial system is also giving them opportunity to improve their social status. What it does, what it can be achieved through financial inclusion? Financial inclusion thus improves and enhances the income opportunities for people, particularly for the marginalized sections. The economic participation also increases of different sections of the society, thus bringing more prosperity in the economy. The financial inclusion is thus very essential for broad-based and equitable growth in an economy. Let us now try to understand the risk distribution and management. Financial system distribute risk across different participants. There are different ways through which they can distribute the risk. It includes diversification. insurance mechanism. Diversification refers to when the risk can be divided into different entities. But this concept is sharing of the risk, not transferring risk. Second is insurance mechanism. There are different insurance mechanisms can be there depending on the type and need. Financial instrument, different financial instruments for different type of needs. This also reduces uncertainty in economic activities, and risk sharing encourages investment and innovation. Let us now try to understand another issue, that is liquidity creation. Liquidity ensures availability of funds when required. It refers to ready cash or ready digital money that can be spent. Financial system has power to create liquidity. Financial markets enable conversion of assets into cash, and this depends on the type of financial system. It also enable smooth functioning of the transactions. Liquidity supports continuity of economic operations, and this provides lots of opportunities. Support to government and public policy. The financial system also provides support to government and public policies by facilitating government borrowing. Government borrowing refers to whenever government requires extra money to be pumped into the economy, capital loans and capital flows can be taken and facilitated by it. Fiscal operations related to budget of the country, as well as it facilitates implementation of development programs. Government and public policy is very important sector for any economy because it serves people. Thus, financial system enables efficient transfer of public funds to those areas that require immediate attention as well as that are efficient in nature. Financial system thus becomes critical for executive, economic and social policies. Let us now try to understand financial stability, its relevance in financial system. Financial stability maintains confidence in the financial system. Now, this confidence is very important to be understood with respect to a financial system. Whenever people, investors, users, they are confident about a financial system. Because of that, what happens that it starts growing. There is confidence, there is people are investing, capital flows are increasing. If at any point of time people start losing confidence in the financial system, what will happen is an havoc and crisis will gradually emerge in the financial system. It is also said that if there are rumors about bad news related to financial system, if the rumors are not controlled, then even if a financial system is not going to witness a crisis will come. Because information will pass like Chinese whisper, and then it will have impact on the financial system. Thus, the confidence of the people in the financial system is very important to maintain it, to grow it, as well as to save it from future crises. What can happen with the confidence? Why it is important? It can prevent bank failures. It can prevent market disruptions. It can also prevent the systemic crisis. Thus, the financial stability requires effective regulation and supervision. Financial stability is essential for sustained economic growth, which refers to minimizing the crisis from time to time. Let us now try to focus on the structural transformation of economy. Over the years, India has seen structural shifts and transformation in the financial system. The support from the financial system has shifted from agrarian to industrial to service economy. By shift in financial systems priorities, we do not mean to say that sector is not on the focus now, but because of expanding sectors like the service sector in the last decade has expanded more in terms of in comparison to the agriculture sector. So all three sectors are important, but this is how the growth in the sector has been defined. Structural transformation of an economy facilitates industrialization, urbanization, and modernization. Industrialization refers to providing a formal framework for companies and industries to manufacture, and more number of industries should come into the fore of the economy. Urbanization refers to making the living areas more urbanized gradually, and modernization is bringing technological advancement into the workforce and into other foras. Thus, financial system always enables structural change in the economy through all these factors. Another important thing which is done by financial system is the promotion of entrepreneurship. Entrepreneurship provides access to capital for new businesses. Entrepreneurship encourages innovation. It also encourages startups and risk taking. Entrepreneurship is vital for dynamic and competitive economies. New products, new companies, new brands can only emerge through entrepreneurship. At a time when markets are becoming competitive, entrepreneurship is one of the priorities of the government, that people should become entrepreneurs, should bring new products, innovative products, through which we can become more powerful and more economically sound. So therefore, financial system also promotes entrepreneurship by providing access to the new firms, to the startups, etc. Dear students, knowledge seekers, and learners, let us now focus on the reduction in informal economy. Informal economy expands formal financial channels. Dear students, knowledge seekers, and learners, let us now focus on reduction in informal economy. With the rise of financial system and expansion of financial system, there has been reduction in the informal economy. Formal financial channels over the last 10 decades have increased a lot, and it has reduced dependence on money lenders. The money lenders who used to charge heavy interest rates, sometimes more than 30%, not people not realizing it, as well as informal credit system that again relied on and had an element of exploitation because rates could be changed anytime. The reduction in informal economy has improved transparency and accountability in the financial system. Let us now try to understand the development of financial markets. Different financial markets have developed over a period of time, and with the main objective to encourage efficient pricing of assets, to bring new investment opportunities. The development of financial markets also improves capital availability across sectors. It is also important to understand that this helps in promoting deep financial markets, which strengthens the overall financial system, which can provide again a push to the economic growth and economic development of a country. Integrated economic impact. Because of a sound and robust financial system, the economy can witness an integrated, a comprehensive economic impact. Financial system integrates all these things, that is savings, investment, production, and consumption. And together these four can determine the economic growth of a country. And through economic growth, further, the country can achieve economic development, which is also inclusive of the social indicators or standard of living. An integrated economic impact because of a robust financial system creates a circular flow of income and expenditure. This integrated economic impact acts as the core mechanism linking all economic activities. Dear students, knowledge seekers, and learners, let us now try to summarize whatever we have discussed in today's lecture. We have discussed and appreciated that financial system is essential for capital formation, that is bringing new capital, efficient allocation of financial resources, economic growth, financial inclusion, that is bringing more unbanked people into the formal financial structure, and stability, that is financial stability. We have also appreciated the point that the effectiveness of financial system is determined by speed of development, which is inclusive of technological advancement and the quality of growth. Dear students, knowledge seekers, and learners, thank you very much for being with me in this session.